Welcome to the Landlord Profitability Playbook podcast, where we share the best practices we use to help our residential real estate investor clients automate their rent collection and get on with their lives. Check out the show notes at landlordprofitabilityplaybookpodcast.com. This show is brought to you by Roost Real Estate Company, Property Management. To learn more about the services we provide, visit investwithroost.com. Now, here's your host, Chris McAllister.
Welcome to the Landlord Profitability Playbook podcast, where it's my job to create and coach business opportunities and strategies that support and add value to the lives of real estate investors. I'm Chris McAllister, the founder of Roost Real Estate Company, and I'm here today with our Director of Marketing, Lacey LeBlanc. Good morning, Lacey.
Good morning, Chris.
So today we're going to dive into what it's like or what priorities might be for investing in Ohio. And the actual full title is Investing in Ohio Isn't Safe, It's Predictable, and why that matters. So most real estate investors start with the same assumption. If I just pick the right market, everything else will work itself out. And I get why people think that. We all want certainty. We all want to believe that there's a safe place to put our money and where the surprises disappear. But I can tell you that after owning and managing and advising on hundreds of rental properties across Ohio, I've learned something that runs counter to that idea. Ohio isn't a safe place, even though we've got a lot of investors from all over the world that originally thought it was. But I can tell you that Ohio is predictable. And for landlords, predictability is a heck of a lot more valuable than safety. So in this episode, we're going to talk about what predictable actually means in rental real estate, why Ohio behaves the way it does, and how our three original core markets, Columbus, Dayton, and Springfield, Ohio, can produce very different outcomes, even though we're all in the same state and we're all basically right along I-70. So if you've ever wondered why your property feels harder than it should, this conversation might explain why.
I feel like this conversation needs a lot of arguablys interjected into it. But because they're pretty strong claims that you're making, that picking the right market isn't enough. So talk to me more about that and tell me why so many investors get this part wrong.
So market selection, I think, has been overly simplified. Investors are taught to chase labels, right? Safe, hot, emerging, cash flowing, instead of understanding how markets actually behave over time. And that phrase over time is key, because if you're a rental real estate investor, your time horizon is a huge variable and a huge factor that can work in your favor. Two landlords might buy, in the same market, even in the same neighborhood, and still have wildly different outcomes. The gap usually isn't, a difference in effort or intelligence. The gap is almost always in expectations. So if you understand, or if you misunderstand how a market behaves, I guarantee you're going to make the wrong management decisions. And the market is pretty unforgiving. Eventually, it will correct you.
Yeah, this reminds me of the conversations we've had. We've actually got a two-part podcast episodes called The Seasons of Investing. So we'll put the link to that in the show notes, because I feel like that's like required. It should be the required listening before you get to this point about how markets perform. But you make a distinction between safe and predictable. Tell me what the difference in those is. What do those really mean when it comes to real estate investing?
Predictable doesn't mean that nothing ever goes wrong, right? Properties still break, tenants still move, rents still fluctuate. But predictability means that those things happen in patterns that you can plan for. Employment changes slowly. Rent growth comes in increments, generally not spikes, right? Maintenance costs tend to repeat. And outside of the COVID window, I don't want to say that they're perfectly stable, but things are clearly a lot more stable here in 2026 than they were from 2022 through, let's say, 2024 and even 2025. Taxes and insurance, they tend to go up, but they tend to go up predictably over time, and they virtually never spike overnight, at least not in a more predictable market like Ohio. And most importantly, predictable markets reduce compounding risk, right? They reduce the chance that multiple problems or multiple challenges hit at the same time, right? There are markets where there's a lot of moving parts and a lot of good things can happen at once and a lot of bad things can happen at once. And that's where portfolios usually get clobbered.
Yeah, that's a good point. I think here, I mean, North Carolina, as we've talked about, and our property taxes, our tax values of our properties did rise pretty suddenly, I guess, and by a lot. But one of the things that I think, you have to keep in mind is just because, the tax assessor says your property value is worth more, that doesn't mean people are automatically able to pay way more, right?
Right, right.
So I think that's another good point is how all these things work together. But a lot of landlords hear the word predictable and assume kind of low growth. It's like they think that's the synonym. How do you respond to that?
Before I jump into that, I just want to touch base on the tax situation because in Clark County, where Springfield is, where I have most of my rental properties, we just went through our 5-year cycle and our taxes went up dramatically. Now, was that predictable? God, you know what? It was. We never talked about it. We never wanted to think about it, but the tax rates didn't go up. It was just that dramatic increase in value, post COVID, that 5-year period where property values went up so dramatically. That's why, our first half tax bills went through the roof. It was predictable. I just didn't do it. Right. I could have done the math. I could have, said to myself, well, you know what, 5 years ago, I could have sold this property for 100,000. Now I've got to sell it. I could sell it for 150,000. I could have done the math and said that my $1,000 tax bill was going to be 1,500 this year on that property. And I didn't do it. Sometimes what feels like a spike is, if you look back on it, it could have been predictable, but
Well, and you also didn't raise your rents by 50%,
we
right?
did, and even though we've really enjoyed some pretty solid rent growth the last 5 years across all the markets we work in, it kind of feels right now that we're a little bit behind again. And now the challenge this year is going to be, raising the rents a reasonable and predictable amount for the tenants, but keeping the thought in mind that our cost structure has changed, and now we've got to figure out how far can we reasonably push those rents to capture, what's actually happened with the taxes. So it's something we all have to deal with as investors. It happens every 5 years or so in Ohio. I think it's 5 years. It's either 5 or 7, but it is known information. It is something that can be predictable. But in any case, your question was that predictable, might equal slow or low growth. And I think that's a bit of a misunderstanding. Predictable still doesn't mean that the upside is capped, just like we still have room to raise our rents every year, a reasonable amount. And I say reasonable in that 2 to 4% range, maybe even 5% given neighborhood. But that's a far cry from the massive spikes that we saw coming out of COVID, where some folks were able to raise their rents 10, 15, even 20%. So predictable doesn't mean that the upside it's capped, but it does mean fewer surprises. Long-term landlords don't fail because appreciation was modest, right? Any appreciation is a wonderful gift, right? They fail because volatility stacked up faster than their cash flow could absorb. And that's sort of what we're dealing with right now after the property tax payments that are due this month, February. So predictability also allows you to stay in the game long enough for long-term compounding to work. And that's where real profitability lives.
Yeah, that makes sense. But what might not make sense to people listening is, what's so great about Ohio, right? What makes it so much more predictable than another state or another area of the country, and therefore a good place to invest as long as you understand what you're looking at.
Well, I know Ohio. I know most of Florida, but Ohio isn't driven by a single story. And I say that because I don't know about the other 48 states specifically because I haven't worked or invested there. But Ohio isn't driven by a single story. There's no one industry propping everything up. Employment is spread out across healthcare, education, logistics, manufacturing, defense, and government. And population growth is modest, which means we may not be having explosive growth like, say, Texas or Florida, but it also means we're not having dramatic declines in population. The housing supply itself tends to change gradually. And most renters are renting, because they need a place to live, not because they're just passing through, right? So there are in some of the high growth states, you've got people that come in, they may only stay in those states, stay in that job for 2 or 3 years or even less, and then they move on someplace else. That tends not to happen nearly as much as in Ohio as it might in some of the high growth or Sun Belt states. So the unique properties that make up the Ohio economy, it tends to create stable demand patterns that landlords can actually manage into, if that makes sense.
No, it does. And yes, I mean, stability is a nice synonym for predictability in a lot of ways. And I think, again, I'll use North Carolina as kind of the alternative to this. We were a big furniture state, especially Western North Carolina, big area in furniture manufacturing. So when the decline of furniture manufacturing came about, it wasn't sudden, but it felt sudden. Our whole part of the state really struggled. And that's just an example of the kind of the alternative side of things. There was one industry propping everything up. And so when that industry kind of failed, everything went downhill. But so just as a counterpoint. But let's talk a little bit about Columbus. So people call it Ohio's safe market, but I'm guessing that you might not agree with that.
I think the label safe might miss the point a little bit. I don't consider any market safe because that implies an absence of risk, right? The fact is, Columbus isn't safe or, to be honest with you, forgiving at all, especially on the front end when you buy a property. The entry prices in Columbus are higher than most of the state. I would say the rest of the state. And competition for those properties is intense. And cash flow at acquisition and even the first 2, 3, 4, 5 years can be thin, especially if you're getting a loan. So where Columbus forgives mistakes is on the back end, right? At the end of the life of that rental property. So liquidity and appreciation have historically covered a lot of sins, if that makes sense, right? So even if somebody overpaid for a property, in almost every instance for the past probably 20 years in Columbus, appreciation and the final selling price at the end of that hold period has really covered a lot of mistakes. It's really bailed a lot of investors out. So the cool thing about Columbus is it's tough on the front end, but there tend to be a lot more exit options, and then there's a lot more forgiveness. But still, that forgiveness, to get to that period where that forgiveness is available, still requires patience, right? It still requires time. It still requires a longer term horizon. So Columbus doesn't reward urgency, but it does reward staying power. Does that make sense?
Yeah, it does. It sounds like, buy and hold is the
Yeah.
potentially the right answer in Columbus.
Well, people tend to, there's people who buy rental properties in larger complexes in Columbus, with, negative cap rates, with the understanding that they're going to sit on that for 10, 15, 20, 25 years. And at the end of that period, appreciation is going to make them a tremendous amount of money. And that's why you have so many institutional investors buying up in Columbus for the long term the last few years.
Yeah, so what kind of investors maybe would struggle in that area then?
Any investor who needs an immediate return or needs to see immediate performance. If your deal only works if rents jump quickly, or if it looks like there's room to raise the rents on the property you have and you bank on that, it's just a bad bet, right? So if you're betting on rents being able to go up dramatically or expenses are going to magically come into line, because you're the best operator out there, I got to tell you, Columbus will feel frustrating. I would say it's not quite as extreme as what's the Mike Tyson story? Everybody has a plan until they get punched in the face. Columbus is sort of like Mike Tyson, right? Everybody's got a plan until they get punched in the face. So profitability in Columbus tends to show up later. So you need adequate money, capitalization, and you got to have the discipline to let the market do what it wants to do for you over time.
Yeah, don't sell when it's low. Right? Like, don't get scared and get out when it drops. Dayton, on the other hand, behaves very differently. Talk to us a little bit about that market.
Well, Dayton is about stability. It's not about speed. It's a classic Rust Belt city. It's anchored by institutions like Wright-Patterson Air Force Base, which has been a massive, win for the area, gosh, my entire life. And it attracts a lot of different types of businesses. It attracts some technology, and it's just great to have that giant government entity there now and hopefully forever. So there's also a lot of respected healthcare systems. There's still some solid manufacturing that goes on in the Dayton area. And that type of institution or economy tends to produce, from an investor perspective, that type of economy tends to produce longer tenancies, right? If somebody's going to rent a property, again, it's not about, they're not only just going to be there for a year, 2 years, 3 years. If they find a property that works for their family, that's priced right, taken care of, they're going to stay there for a long time. So again, longer tenancies, which translates into steadier cash flow for the Dayton investor. But the other side of that is it may take longer to lease the property. So there may be slower leasing velocity than, say, Columbus, and more modest rent growth. But again, you're going to be able to buy that property for a lot less capital up front than you would if you're comparing Dayton to Columbus. So Dayton rewards consistency. Dayton investors tend to get into trouble if they expect Columbus style acceleration, right? If that makes sense. That's not what the Dayton market is built to deliver. It's beautifully predictable, and beautifully boring.
Well, and I think this question really isn't in our list. It does kind of play a role, I think, in the next question about what role does Dayton play inside a larger portfolio. But what I'm hearing is what type of investor do you want to be, right?
Yeah.
What type of, like I'm hearing a lot of, what is your risk tolerance, right? What do you want the day to day to look like for you? Whether you're working with a property management company or you're self-managing, these different markets, not only, do you look at your portfolio and the charts and the graphs and the numbers and see big differences in how they operate, but also the first thought in my mind is, man, that sounds like a much better place for me, right? As a property owner, because Dayton sounds like my place. Columbus sounds like a lot of work. Dayton sounds like, yep, let's get a tenant in there and keep them and that modest growth, and I'm happy with that. So as we talk about kind of what role Dayton plays inside your portfolio, maybe if you could address those
But
points
we
as
have a lot
well.
of investors, landlords that we work with who have multiple properties, and they may have those properties in Dayton, Springfield, Columbus. I personally have properties in Springfield, Columbus, and the Space Coast of Florida, and I have clients, that I've sold properties to in those areas. So when you start thinking in terms of building out your portfolio and managing that risk over not just geography but time, that's where you think about a Dayton market, right? Dayton tends for these folks to act as a stabilizer, right? It may be a little more fun, a little more dramatic, a little more exciting, let's say in Columbus, 70, 80 miles down I-70, but Dayton will smooth out your cash flow, right? It doesn't excite, it steadies. And when managed correctly, you know, renewals, keeping those tenants year after year after year produces insane value over time. And having those properties, buy them right, manage them right for the long term, a Dayton type of market reduces your volatility across the entire portfolio. So, I guess we are speaking to people who have a long-term horizon and want to, buy several properties over the next 20, 30 years, or maybe they already have properties. But I want people to be, very intentional about the markets that they're buying in, and most importantly, understand the markets that they're buying in.
So what does that mean for Springfield? Springfield's kind of associated with cash flow. What's the trade-off there?
Springfield absolutely delivers strong cash flow, right? Entry prices are lower. It's easier to control your costs up front, right? Especially compared to Columbus, but there is very little appreciation driven forgiveness down the line. Yes, we've enjoyed massive increases in value just like everybody else, but it's all relative, and I really feel like those days are over. That was sort of a snapshot in time. But when you buy a home in Springfield to rent it out, you've got to make sure that you buy it right. If it doesn't make sense on the merits, right? If the property doesn't pencil out, as they say, the Springfield market will not save you, right? Liquidity is thinner, vacancies hurt faster, mistakes carry more weight. Springfield doesn't punish ownership, it punishes those investors who assume appreciation will do all the work and bail them out at the end. And that's just not what Springfield is about.
So given that, who should and maybe shouldn't be investing in Springfield?
Well, Springfield works for disciplined operators who understand the trade-off between monthly cash flow, which is going to be honestly superior to anything that you're able to pick up in Dayton and especially Columbus. But they understand what they're doing. They understand that trade-off, and your operation has to be sound, right? You got to have tight screening. You got to have, solid rehabs that are well managed down to the last dollar. You can't let maintenance get away from you. Deferred maintenance will just destroy these 100, 120, 150-year-old houses, right? We have very old housing stock, just like a lot of Dayton, you know. But those operational disciplines, those standards, those are non-negotiable. And investors, again, who are counting on time and appreciation to fix weak execution, those folks will find Springfield extremely unforgiving.
So it feels to me like it's just like this magic trifecta. But when you look at Columbus and Dayton and Springfield all together, what's the bigger picture look like there?
I just want to make it clear, and I think the story does, that markets aren't just locations, markets are behavior patterns. Columbus absorbs volatility, right? Dayton smooths out cash flow. Springfield magnifies decisions, good or bad. There's not one of those three markets that inherently better than the other. The problems arise when landlords manage, one market as thinking that it's going to behave like another. Profitability comes from operational alignment with the market. It doesn't come from wishful thinking or just optimism.
Yeah, and I think there's something to be said, again, for working with a property management company kind of native to the area, right?
Yeah.
I can only imagine trying as someone who not only maybe does live in the area but hasn't lived there for a long time. It's really hard to know what the market cycles look like, and it's really hard to, I think, understand locations where you can only really live in one place at once, right? Where you don't physically live. So, I just that's what I'm thinking this whole time is, man, that's a lot of information gathered over a really, really long period of time by people who
Yeah.
are really ingrained in this work day in and day out, not only because they're investing, but because you're working with people, who have investments in addition to yours. So, how do people, smaller landlords, people with maybe one or two properties, how do they that may be self-managing currently, how do they apply this thinking?
Um, well, before I answer that, I do feel that I should point out that, we've been managing in Springfield for other people, not just what we own, since 2009, I believe, is when Gretchen got her license. We've been at it in Springfield for 15 years now, and we will continue to work and invest in Springfield for years and years to come. But it took a while for us to internalize what Springfield was all about, and it took us a while to internalize what it was all about relative to the other markets that we work in, and how that's going to be different when we start working, in Cincinnati and Cleveland to the north. But anyway, as far as smaller landlords, even those with one or two properties, I just want anybody, any investor, every property sits inside of a broader behavior pattern. And when landlords judge performance in isolation, everything feels urgent and everything feels personal, right? If you understand the market and hopefully are able to make predictions, right, about the market, that's going to allow you to plan for variance instead of reacting to it. And sometimes it's not even actionable plans. It's about adjusting your expectations and have an understanding of what is likely to happen based on, how behavior differs from literally one city, one market to the other. And that kind of knowledge is incredibly powerful. And that and the planning that goes into how you're going to purchase and operate those properties, that tends to compound too. So when you have your expectations set appropriately, when that knowledge really becomes personal power, your stress starts to drop, you start to make better decisions, and those returns tend to become more durable for, over time, right? It really does come down to understanding what's happening versus succumbing to, we've talked about this before, what I always call magical thinking.
I'm a big fan of magical thinking, but figuring out how it's going to translate to the real world is the real challenge. No, I think all of that makes sense to me, and it just reiterates the value, I think, of looking at your investments from 5,000 feet, right? From the portfolio level, and having partners that do that. What is your final takeaway for folks listening today?
The most profitable the investors that we work with, the ones that make money month after month, year after year, year after year, they're not chasing markets. They're building portfolios, even small portfolios, that will behave well when conditions change. In Ohio, when you understand the state properly, when you understand the different markets properly, you really get to capitalize on what's possible, right? So again, it's not about chasing markets or the best market. It's about choosing a market, understanding the type of market you're getting into, setting up your expectations accordingly, and hanging in there for the long term.
And choosing the right people to work with, just because
Yes.
that's my job. That's my job here.
Yeah. And again, these are our core markets, and we are looking to expand throughout Ohio over the next 2 or 3 years. But these are the ones that we've been working in since 2009. We know them, we love them, we invest here ourselves, and I just personally want everybody to understand what makes Ohio a great place for real estate investors. So if you'd like to learn more about how we work with investors like you, check us out at investwithroost.com. And if you'd like to go deeper into the subject, I want you to check out our new blog post called Investing in Ohio Isn't Safe. It's predictable, and that matters, at learnwithroost.com. Thank you, Lacey.
Thanks, Chris.
And thanks to everybody for listening.
See you next time.